Hey everybody, welcome to the No Shill Zone. It's that special time, Monday, 11 a.m. I'm joined by Ben Cowen. How you doing, Ben?
Pretty good. How about you? It's been a very eventful week.
It has. I'm a little under the weather, but we're going to knock this one out of the park. I think we'll be joined by David Lynn shortly as well. I know people got real excited when they heard about the pairing here today on the No Shill Zone with him.
Yeah, hopefully he'll join in a few minutes, but we want to be prompt as always and get this kicked off. So, Gareth, we saw a pretty big event here happen, over the last couple of weeks. Not just in crypto, right, but in equity markets as well. We've seen stocks drop 4 to 5% on average. Like the S&P, I think, is down somewhere between 4 to 5%. But I think the bigger news is we saw Bitcoin drop 10%,
Yeah.
like this last week. So, well, what's going on here?
Well, so the first thing is, we came from a period where there was the least volatility in history. And one thing I remember you and I both saying is that when that happens, it's usually the precursor to a big move in Bitcoin, whether it was up or down. I happen to believe it was down. I believe you were as well in that camp, just because, again, you've been in this period where we're up against major resistance and we're likely coming down. So the question is, what was the trigger of it? Was it the stock market? Was it we kind of heard that SpaceX might have been unloading Bitcoin and that kind of panicked. But one of the things I will say from a pure technical point is that when you break the support here at 28, and this is a level that I've had on the charts for a long, long time, in such a light volume environment, it creates kind of like a vacuum in that there's no bidders below, right? You can trigger a lot of stops and it creates this big move down because there's just not enough buyers there. And that's really, in my opinion, why you see these big moves, especially when you don't have a lot of volume or liquidity in the coin. Now, the crazy thing about it is now that we've broke that trend line, the question is, do we hit 25, which was the BlackRock news low before we popped up on the spot ETF news? And then if that breaks, do we go to 20 and then eventually back to the lows? And I'd be curious to hear your take on this, because we saw altcoins, by the way, get hammered as well.
Yeah, I mean, so Bitcoin, one interesting thing about Bitcoin is that it's actually done this exact same thing every pre-halving year. And I think we even talked about that. I think we've been talking about that over the last few weeks. And I mean, it's not to say that the cycles have to repeat exactly. I mean, the price movements will be somewhat different, but there is at least some seasonality, right, to the Q3 timeframe of the pre-election year, Q3 timeframe of the pre-halving year, where Bitcoin likes to drop below this key, these key moving averages. And it normally sort of sets up that secondary scare going into, before you really get into the real bull run that could maybe take you to new all-time highs. And, I'm still at the camp that Bitcoin's not going to see new highs until we actually get back to some form of quantitative easing.
Yeah.
I think we're going to be facing some macro headwinds until then. But what's interesting, as you pointed out, this low here, right, on Bitcoin and how we haven't taken that out just yet. But with Ethereum, we have. Actually, we already took out that low, and with the altcoin market, we took out. We've been the altcoin market hasn't really been doing that great for a long time. But I mean, you can see that low that was whatever was there was easily taken out as well, and it's been coming closer to some of the actual major lows that we saw in June and in January of 2023. So my general expectation with this move is that it is a risk-off move. It's a clear risk-off environment, coupled with the fact that the S&P is down about 4 to 5% this month. But additionally to all that, you have the long end of the yield curve breaking out again, right? I mean, that's the big story, because we had the 10-year. We talked about this back test. I believe you mentioned it. We were talking about this back test here on the 10-year yield and how if it holds and we just skyrocket back up to these highs, what's going to happen, right? You see the bond market fall back down, right? And we've seen TLT do exactly that, and it's back down to these lows, just as the long end of the yield curve is back up to these highs. And what I really find interesting is that, and I know there have been some people that have talked about this with regards to the altcoin market, is that the dominance of Bitcoin has come back down a little bit, but as long as we're holding above these prior range highs on the weekly closes, then I still think it's nothing more than a back test of the prior breakout point.
Yeah, and just to add something to that Bitcoin dominance is the reason why you see a little bit of a dip in Bitcoin dominance is because people got very accustomed to there being no volatility in Bitcoin, which meant that they over leveraged, right? So you had over leveraging because in Bitcoin, you couldn't make much money because there weren't big enough moves. And so it coaxes people to kind of this false sense of security where they over leverage. And then when you finally get that move, all of that leverage has to come off, which means the fall is bigger. And I think that's kind of explains it. And I know also, at least on TradingView, they kind of did a few little odds and ends and changes, as well. But we digress.
Right, of course. It looks like David has joined us. Can you
Hey, David, what's going on, buddy?
Oh, hey, good morning, guys. How are you?
Good, from the David Lynn Report. So happy you could join us, man. I was thinking this would be a great little group trio here that we could knock it out of the park today for people, give them a little bit of a different angle. I'm sure you have some questions and thoughts on the overall Bitcoin market that you've been contemplating. But yeah, man, welcome and thank you for joining us.
Yeah, no, thank you guys. Two of my favorite analysts. So appreciate you guys having me here. Big fans of both of your work. So yeah, good morning. I see you've already started. I'm sorry I'm a bit late, but let's get right to it.
Yeah, absolutely. All right. So I agree with Ben in that we're looking at a potential breakout here. And this was that chart that we talked about last week where you have the high from October on the 10-year and you're actually now moving a little bit above it. Now, what's so fascinating about this, and we're going like multifaceted here, where you have a higher high being made on the yield versus the October high, which marked the low on the stock market. But the markets today are actually slightly positive. And I would just like to bring up this one stock right here is the culprit, right? We have, that's the NASDAQ. It's NVIDIA, right? So NVIDIA is just having a rock star day. We saw, I think, an upgrade today with a price target of $780 a share. And for me, I look at these type of events as topping signals. So it's, think back to in Bitcoin when everyone was saying, hey, by the end of November 2021, it'll be at 100,000, then 150, whatever it was going to be. And so when you start to get these analysts throwing out these kind of ridiculous price targets, to me, it's more of a warning sign than anything else. So I don't know if you guys have any thoughts on that, but it's really, it's remarkable because in this environment, the dollar's been rallying since the open. That's usually bearish for equities. Yields we talked about, and yet the markets, again, are holding up because you have this one stock that's like a shining star.
Yeah, I mean, I think you're right. I think I saw someone that they revised their price target for NVIDIA up like several hundred after, in the last few days. And this is, I mean, it's people just chase the market, right? And if NVIDIA starts to drop, they'll revise all those targets back down. But I know a lot of people have listened to my views and Garrett's views. I would like to spend at least a couple minutes. I want to hear what David thinks about all this. David, could you walk us through? Because I mean, look, if you guys aren't subscribed to David, make sure you go subscribe to him, okay? Because he's got a great YouTube channel. He started it not that long ago, and I think he recently broke 100,000 subscribers, right, David?
Yeah, I'm at 103 right now, but thank you. I've interviewed both of you. It's grown because of people like you coming on their show. So thank you, guys.
He sells himself short. So he also has, I think, a really great understanding of the markets as well. Even though, and by the way, I mean, he interviews everyone, so he gets to see like all the doom and gloom and all the hype, and maybe bring it back together to a more realistic outlook. So, David, what are your general views on the market right now?
So, just as this disclaimer, I have interviewed people from all angles. So I'm a good aggregator. I can do some analysis with you guys, but I'm nowhere near as smart as Ben or Gareth, which is why I interviewed them. Otherwise, I'd be interviewing myself. Have you guys talked about yields yet? I know I jumped in like 3 minutes late, but
we were just touching on it a little bit, how the 10-year is starting to break out, and I would like your thoughts on that. Of like, are we going to start seeing we obviously have had massive inversion, but are we going to start to see the long end catch up?
So, well, the long end's already been moving faster than the short end. So the 10-year has been moving up more than the 2-year. The 2-year's kind of been flat, and the 10-year has just been skyrocketing. And so, I don't know if I brought this up to you, Gareth, last time we spoke, but typically what we've seen in the past, not typically, but pretty much every single time, before a recession officially hits, the yield curve has to invert and then re-invert or uninvert back to zero. Right. So it goes down to the negative territory, and then it goes back up towards zero before the recession officially hits. That's what's starting to happen now. We've had an inversion of the yield curve for more than a year, and it's just starting to revert back to zero, which is really interesting because in the past that signals an actual coming of a recession. The yield curve inverting itself doesn't really do it. It has to re-invert back to zero. So that's the first thing. The second thing is that you'll notice if you plot the 10-year next to the S&P 500, it's had a pretty much perfect correlation throughout the year. up until 2 weeks ago when the 10-year started to break out and the S&P started dropping. And so that to me signals that either the S&P, well, one of three things, right? So I'll let you guys comment because you probably know more, but one of three things: either the S&P is not supposed to be falling, or is being undervalued right now and dropping for reasons that aren't fundamental, or the 10-year is signaling some sort of either economic recovery or more Fed funds hikes that aren't going to happen, or they're set to diverge from here, and that they don't typically diverge. There are instances in the past when the yield and the stock price move in different directions, but it's not a common occurrence.
Gotcha. Ben, why don't you take it? And I'd love to hear what your thoughts are on this if you have some, because I think we have to recognize that usually higher yields is a negative for risk assets, right?
Yeah. So what I would say, and I just think I showed my screen here, but one thing to consider, and I think this is something that we could all really think about, because a lot of us, including myself, again, have never really fully experienced a full business cycle. But the one thing to remember is that bonds tend to bottom first before the stock market, right? So bonds bottom, then stocks bottom, and then maybe if it's a real estate down cycle, then real estate bottoms. And I think crypto might actually bottom out before stocks, but after bonds. So with the 10-year breaking out, like we see here, right? It's back at this high. It's corresponding to these lows here on TLT. And by the way, I mean, there's a chance that it could be a double bottom for TLT. I mean, you can see that there is some history where it double bottoms. There's also some history where it puts in a slightly lower low as well. But the thing that I would look for is that as the yields break out, right? As the 10-year breaks out, as even the 2-year breaks out, the risk is that the Fed breaks something, right? They push us too far and the economy can no longer bear it. And what will happen if we reach that tipping point is that you will see a complete repricing of the long end of the yield curve if the market starts to sniff out a pivot, right? And so, yes, in the short term, we see these yields, we see the long end of the yield curve breaking out, bonds are down, stocks are down. And, we talked about in this risk-off environment where you get bonds and stocks down, there's not really a whole lot of safe places to hide, right? Except for maybe cash. And so what I would look for is to try to figure out, when will the Fed pivot? And that's why we keep looking, Gareth. We've done this right for weeks now. We go over the initial claims, we go over continued claims, we look at the unemployment rate, and we say, well, at this point, the Fed is still likely not going to pivot, because if you have 3.5% in the unemployment rate and you have inflation at core CPI at 4 to 5%, then they have to continue on. But what happens if in a few months the unemployment rate's at 4% or 4.5%, right? Then they have to start weighing these risks. And once the risk to the economy becomes a lot more weighted towards the labor market over inflation, that's where you get a Fed pivot. That's where bonds bottom, right? And the thing that we have to remember about this is that risk assets like crypto and stocks do not tend to bottom exactly at a Fed pivot, right? It's normally sometime after a Fed pivot. So that's why we say, right, bonds bottom first, then the risk assets. That's where I am right now. I'm looking at the 10-year. It is breaking out. I don't know how much higher it's going to go, but I would expect it, I would expect this move to ultimately lead us into this final move that will eventually cause the Fed to pivot.
What do you think about, I think it was last Wednesday, we got the Fed minutes and they were surprisingly hawkish. I think the market got caught off a little off guard on that. And then this week, we know we have Jackson Hole where we're going to get a speech. So do you think, when we get that speech, are you anticipating a Federal Reserve Chair, Jerome Powell, to be saying, hey, I'm going to still have to raise rates another time this year? Or do you think he's going to kind of throw the market a bone and says, hey, it's a wait and see? I'm not 100% sure.
I actually think I would say there's probably a 60 to 70% chance we're already at the terminal rate is kind of what I'm thinking. If you look at the year-to-date ROI of the S&P compared to all prior pre-election years, this is where we currently are. And historically, we get this risk-off environment right around now. And then historically, we kind of go sideways into the end of the year. Sometimes we rally up at the end of the year. But I sense that with this hit that risk assets are taking, they would almost just be better off just kind of sitting where they're at and seeing, what type of damage that does. If they were to tighten further, then I think they could they really run the risk of breaking something a lot quicker. So I actually think where they are right now, 5.5%, is sufficiently restrictive. The thing is it's not just a level, it's the time spent at that level, right? It's not just 5.5%. It's what if you spend a year at 5.5%, right? That is how you ultimately see it filter through to the economy. So yeah, I mean, at this point, because we have this risk off dynamic, I don't really see a reason for the Fed to pivot. By the way, Gareth, do you remember we were talking about this chart? Net liquidity.
Yeah, the jaws. I still remember
The jaws have opened. And yeah, I mean, they've started to close a little bit here, but still a long way to go. And actually, what's interesting is the jaws right now are actually at the October 2022 low.
Wow.
Which is, I mean, look at it. That's exactly where it is. So that's the thing where, like, right now, no one expects the Fed to pivot, right? I mean, I think the bond market is predicting a Fed pivot like in May, I think, of 2024. But I'll tell you this: if the S&P were at 3,400 as opposed to 4,400, the Fed would probably be pivoting. Okay, it's just like, when does that happen? It's hard to say, but if and when it happens, that you're probably going to get a Fed pivot at that point, because they're not just going to sit by and watch the economy tank forever.
And I think it's important to recognize the Fed, just like us, has mentioned that there's a lag effect on interest rates, right? So, 6 to 12 month lag. And so there's still a lot of hiking that's going to hit the market on a delay that the Fed hopefully is aware of. And that's why I kind of agree with you. Now, David, I'd be curious from your perspective. You interview lots of amazing people on your channel. Like, what are you hearing that, like, has there been a decidedly bullish turn from people? Because I mean, listen, I think early in the year, in myself included, I was somewhat on the bearish side, starting March or so. But have you seen a rotation at all?
The bears that have been bearish since March are still bearish, and the bulls that have been bullish since March are still bullish.
So everyone's holding the line. Hold the line.
so yeah. There's definitely two camps. They haven't really changed their opinion. And when you think about it, the fundamentals of being bearish and bullish haven't changed, right? So if you're bullish because you think that the economy is going to move towards a soft landing, well, you have all the evidence for that view. In fact, the evidence is playing out even stronger now than it was a couple months ago. If you're bearish because you think that the stock market is overvalued, and so if you think that the stock market's due for a correction, or you think that things like Nvidia, like you mentioned, shouldn't be priced the way it is, valuations being one of the reasons. Well, valuations are even more overstretched now than in March. So all I'm saying is that it doesn't matter what camp you're in, your thesis is even stronger now than before.
Yeah, it's actually amazing to think about, right? How usually you get one side to be proven wrong, but for probably the bears to throw it in, at least for myself, I would want to see us in 6-12 months, so all of the rate hikes kind of filtering into the economy, and then I'd want to see, are we above the all-time highs on the S&P? In that situation, then yeah, I think that there's no doubt about it that it's a bull market and it's a strong economy. Again, I just come back to.
It's really interesting how if you take a look at the CFTC S&P 500 futures, the net speculative position right now is still negative. It's been very negative since July last year, and it's been the most negative. I don't know if I can share my screen.
Yeah, you can. And I can pop it up if you want to show.
Yeah. So let me just. Okay. Present screen. There we go. All right. So this is just futures positioning. Okay. It's not. All right. So if you take a look here, this is for the S&P 500 futures. It's been negative since last year, when I guess sentiment started turning bearish. It reached the most negative accumulated position earlier this year. And then now it's starting. Sentiment is starting to turn more bullish, but it's still in negative territory. If you look at a lot of Wall Street firms, like the Bank of America, for example, they've actually switched their stance to a soft landing by this year. See, Bank of America raises U.S. growth forecast on soft landing expectations. So they changed. The brokerage no longer expects a mild recession in 2024. Sees real gross domestic product growing 2% on average this year. So if you're going back to your question, Gareth, the people that have spoken to me, they haven't changed their views, but a lot of big Wall Street firms have this past month. Bank of America.
I was going to say I've heard that too. I've heard that a lot of the funds out there, and it's not necessarily that they're super bullish, right? It's that they have to chase the market. If you're a fund, You can't sit on the sidelines and watch the NASDAQ go up 20, 30%, right? So I have seen that, and I have read about that, how a lot of funds have been forced to go bullish, regardless of what their viewpoint is. And it does make me, believe it or not, something like that, I look at as a contrarian indicator, right? So once you get everyone bullish, well, or majority, that's more likely to be a bearish signal. Now, like you showed in that chart, we still have more bears than bulls, though.
Yeah. We currently do, although the trend, according to the chart, has been shifting towards less, I wouldn't say more bullish, but less bearish if you count the accumulated net speculative positions as an indicator of bearishness. I am wondering, this is a question I asked my bears on my show, is we have these Wall Street firms changing their stance, presumably on, well, according to them, on new economic data that may indicate renewed strength in the economy. They're looking at the labor market being strong, for example. They're looking at retail sales continuing to be strong, for example. So I always ask the bears, if you look at the same data, why haven't you changed your view yet? Right. So
and I'll let you you take that, and I can always take it after.
Yeah.
Yeah, let me see if I can. Yeah, can you see my screen?
Yep, let me pop it up here. There.
So, I mean, at this point, as I've said before, right? I mean, it's still entirely possible that the stock market could rally into Q4. If you just go by seasonal corrections, we get a seasonal correction in the S&P in August and September of the pre-election year. There's no guarantee that that continues in Q4. For all we know, the market will rally back up in Q4. Maybe it'll go to new highs. Like I can't possibly know, but and again, like that's what it did in 2019, and it wasn't until the election year that we got the recession, right? And in 2016, it was the early part of the election year that things like the Russell 2000 finally bottomed out. So there still exists a path where the market could rally if the labor market doesn't fall before, say, the end of September, right? So if it's the end of September and initial claims are still at like 230, 240, 250, and the labor market is still at 3.5% unemployment, then yeah, like maybe the market will rally in Q4. It just depends on how long it takes. But here's the thing, like if you look at, so we know yield curve inversion typically precedes recessions. If you look at, say, like the spread on the 3-month and the 10-year, and you plot out various macro metrics from when they inverted to when, until the low, like here's one for like advanced sales for retail trade. Like it's tracking, you can see that it often will track up for a while, but then there's this lag effect of the interest rates that will then eventually hit the economy. Take a look at initial claims, because I mentioned that one just a minute ago, and just look at and I'm going to exclude the pandemic just because it kind of makes everything harder to look at. Initial claims tends to trend up slowly at this point, right after we're about 9 to 10 months in. But as you get, 15, 16, 17 months in, that's where it can often accelerate. And so I think that it's reasonable to be a little bit cautious here for the S&P, even if you're a bear, to say, well, if the labor market doesn't convincingly soften up by the end of September, then there might be enough fuel for it to rally into the end of the year, whether it's a new high or not. If, on the other hand, initial claims and continued claims start spiking, which is a risk, especially considering, that the market is going down. Remember, the market leads the market leads. So if you're a company and you're watching your stock prices fall, what are they going to do? They're likely going to cut people and try to reduce costs. And if it falls enough, then it can be this, this pretty bad feedback loop. So that's where I currently am. With the stock market, I'm sort of in this camp of like, all right, we're just in a normal correction right now. There's no guarantee this is quote unquote the big one. For crypto, I think it's more likely a downtrend for the rest of the year because it's just further up the risk curve than the S&P. And I think that once crypto gets flushed out fully by the end of this year, early next year, then that will be the time that crypto does well. But that will likely correspond to the final flush in the S&P 500, which might not occur until sometime early 2024 around a theoretical Fed pivot.
But Ben, you're talking about an event that has never really happened in the last couple of years, which is Bitcoin diverging from the S&P 500.
What do you mean? It has, though. It has. So if you look at Bitcoin, this is the Bitcoin chart, right? And you pull up the S&P in 2019. Look at this. The S&P got this seasonal correction around August, September, and then the S&P put in new highs. And during the time that the S&P put in new highs, Bitcoin still was going down, right? So Bitcoin was in a downtrend for the second half of 2019, even though the S&P was going up and putting in new highs. So a lot of people keep saying, well, if the NASDAQ puts in new highs, if the S&P puts in new highs, if the Dow Jones puts in new highs, it's only a matter of time before Bitcoin does. I would beg to differ. And it's because Bitcoin is further up the risk curve. Bitcoin will likely not put in new highs until after we get back to QE and after the uninversion of the yield curve. And you can see, where did Bitcoin start tracking the NASDAQ again, or the S&P 500 in 2020? It wasn't until after we got to the last rate cut in March of 2020 that Bitcoin really bottomed out, and then starting to track in the S&P 500 again, and then put in new highs. So I think we have to be careful with assuming that the S&P and Bitcoin are highly correlated for the entirety of the market cycle, because in pre-halving years, Bitcoin tends to go down for half the year, regardless of what the S&P is doing.
Fair point.
It's interesting. I would just like to see, at least from my perspective of why I remain bearish, is that while the jobs data has remained strong, the underbelly of jobs is a lot more part-time work versus full-time, and that's been a trend that's been kind of escalating recently. And then I also think, like, you have to take into account we're a global economy now, and look at what's going on in China. And it's another thing we haven't touched on, but China cut rates last night. But interestingly enough, and this is, I assumed that they would come out with bazookas, but they actually cut rates less than the market anticipated, which I find fascinating, because of all countries, they're the ones usually that want to do it the most to stimulate growth in their country, especially with deflation, right? I mean, they have deflation. They don't have to worry about inflation right now. But I think, again, generally it's the jobs market that's the strong one. But I do see cracks emerging in that jobs number.
Well, I think that's exactly why markets tend to bottom out on the last rate cut, not the first one, because normally, like, the first rate cut is not enough, to actually turn the market back around. Like, they just sort of try to lower it a little bit, hope that makes a difference. It doesn't typically make a difference. And then eventually all these central banks are forced to cut in a more magnificent way. And then the market finally says, all right, that's enough. There's my drug, QE. Let's go back up again. But I think that's one of the things, right? Like, just because they cut doesn't mean it's going to change a thing unless they cut a lot.
Yeah, and the other thing to note is that if the Fed funds rate stays elevated without a pivot, like you guys talked about, but if the 10-year continues to move up, or even the 30-year moves up more, what we're going to see is credit card rates rise, mortgage rates rise, even without the Fed funds having to move. So that could be even more dangerous for the consumer and the economy.
Yeah, and I think that you have to take into account all those costs are going up, like you said. And I looked at stats recently talking about the average car payment now is like $700+, which to me is mind blowing. You throw in what a mortgage is if they're taking a mortgage now, and then inflation, right? What are they paying at the grocery store, at the gas pump? And we've seen gasoline prices starting to pop more recently again as well. So there's a lot of pressure. It's amazing the consumer has held up as well as it has, but I would dare say that there's probably still so much excess liquidity in the market that it just takes time to kind of wash out.
Gareth, I'd like your thoughts on something specific. It might actually be timely to talk about. It's a very specific cryptocurrency. I know you're more of a technician than I am. BNB is starting to, I'm sure you've been looking at it, right? Like, it's starting to break down here. And I think the risk is that, it's not too much lower before it starts flirting with its summer of 2022 lows.
Yeah.
A lot of people keep saying that these aren't going to break. And I'm like, they could break, right? So what is the technical target here on BNB?
Yeah, so if you zoom out, you have to go now. You're at a point now where you're below anything since we hit the low in 2022 of around 185 or 184. So that's your zone right now. But I think you bring up a great point with BNB that, I've been talking just in the last week about, there's some rumors floating around that there's some margin calls. There might be some issues there with Binance. And I do think that a black swan that no one's anticipating, we can't remember that the SEC levied some really serious accusations at Binance not that long ago. And it almost seems like it's been forgotten. But if something were to kind of advance on that front, I don't think the crypto markets are prepared for that. If you throw in the higher yields and all the other factors that we're seeing in crypto as well. So just to be careful, but really at this stage, 185 is your downside support. And if that breaks, then then you get into some real messy stuff where you could be headed to 150.
What's fascinating about that chart that you have pulled up, how there's basically no support below the summer 2022 lows for a long time for a lot of these altcoins, but that's also the reverse of what we saw with the Bitcoin dominance, right? Like, once it breaks above that 52% level, there's no resistance until 58, 59, 60%. So I do sort of wonder if we're just watching this train wreck happen in slow motion.
Yeah, for sure. I think that's a possibility. And David, I think with your, you deal with a lot of people that are very bullish on crypto. In fact, I find it fascinating because, almost everyone that's bearish on stocks is probably semi-bullish on crypto. Maybe not everyone, but I would love to hear, like, what are your thoughts on the crypto markets? Like, are you still looking for downside? Are you thinking upside? And you could take into account your personal views, what you've heard, whatever you want to do.
Right. Well, let's just talk about Bitcoin because I don't really follow the alts very much. So, I mean, I kind of agree with Ben here on in that I don't see a lot more upside for Bitcoin right now because the way I see it, Bitcoin has already rallied 80% since its lows last November. It's not like it hasn't moved at all. And then people say, well, it hasn't really beat the market. Well, yes, it has actually. Bitcoin's like the top performing asset in 2023 so far. And so why hasn't it gone up even higher? Well, I don't know. I mean, if your thesis is that Bitcoin is going to continue rallying into economic strength, well, it should have already breached its all-time highs by now. Given its data, it hasn't done that. If you were to consider that Bitcoin is following stocks in parallel every single step of the way in lockstep, well, why has it flatlined in the last 3 weeks or month? Ben can give me the more dates and more detail. When the Nasdaq was trending up.
No.
Right. So people say, well, it's because of crypto specific events like the loss of confidence because of Binance getting sued, Coinbase getting sued. If you consider that Bitcoin was trading mostly from the institutional side, which is why Bitcoin and the Nasdaq were correlated, I don't see why that really matters. And then people will say this is one thesis I don't personally agree with, which is that Bitcoin will rally once the Bitcoin ETF, spot ETF, has been approved by BlackRock. This is the most anticipated spot ETF in crypto history. It's been talked about every single day, to the point where people come on my show and they say, hey, you want to talk about the spot ETF? I'm like, no, like, let's talk about something else because it hasn't happened yet. I don't think that's going to move. Personally, I could be wrong, but I don't think that's going to move the price of anything. We're expecting it to happen, and it's already been baked into the price expectations.
Yeah, no, and I would agree on that front. And is that when everyone anticipates something, it's almost like the halving, right? Is that, everyone anticipates this big rally. Like the common theme that I hear is that, hey, just buy Bitcoin now. Who cares if it goes down to 15,000? Because by the halving, you'll be making so much money, it doesn't even matter. And when people say that, and it's the thought process behind it, a lot of times it's disappointment, right? It's something caveats and changes. What I have up here on my chart is I just wanted to kind of go along with what David was saying, is that, if you look at the retrace of Bitcoin had a very minor retrace compared to the Nasdaq. So being a higher risk asset, in theory, Bitcoin, you're right. It probably, if the Nasdaq got within 25% of the all-time highs, you should have seen Bitcoin probably hit the all-time highs, but instead it underperformed, not by percentage wise, but retrace wise. And I think that's something also that's concerning for me, to see that underperformance when risk assets were just going nuts to the upside.
Yeah, I mean, I think that's still in line though with what we typically get at this phase of the cycle, right? Like Bitcoin just really struggles, and it's really not that surprising to see this happen. Again, 2019 new highs in the Nasdaq. Bitcoin didn't put new highs in until late 2020. This is an interesting chart if you guys haven't seen it. This is Bitcoin divided by the money supply, M2, and we're basically getting rejected from the 2017 high, and also the low from 2021. But Gareth and David, I'd like your view on something else. I put out a video recently, and I don't know if you guys follow this, but this is the S&P divided by the money supply. And does this not tell a fairly interesting story? Like, to say that the three tops that we've seen over the last 3 to 4 years have all been at the same exact level when accounting for M2. I look at the S&P and I say from the high, right? So from this pre-pandemic high, the S&P rallied 42%, right? It was a 42% rally. But guess what else rallied 42%? The money supply, right? Exactly 42%. So I can't get away from this idea that we're all being fooled in the first place of thinking that risk assets are going up. The truth is that nothing's really going anywhere. We're just printing a lot of money and everything is going up. So yes, maybe the S&P went up 42%, but so did your grocery bill, so did everything else in life. And so that's where you get this debasement of the currency. David, are you what do you think about how the S&P is not actually putting in new highs against the money supply really since the dot-com crash, I believe, is when it, if I were to zoom out here, the last time the S&P took out these highs was all the way back up here in like the dot-com era, and that's something that might be worthwhile to talk to a lot of more people who are more bullish on the stock market, and to say, well, is this not just more so a function of dollars being printed rather than any underlying changes in productivity or otherwise growth?
Yeah. Okay, so let's answer this question first. So, yeah, that is a very interesting way to look at it. Certainly the expansion of the money supply has been, undebatably one of the drivers of stock market moves in the last 3 years. I wouldn't say that in real terms the stock market hasn't gained since 2008. If you take, I like to see the S&P in nominal terms divided by the CPI index, because if the CPI has outperformed, which I don't think it has, if the CPI has outperformed the S&P, then you can say definitively that the S&P hasn't really added much value to anybody. But the reality is the M2 growing, while that could be a good indicator for where prices may go in the future, M2 growth has impacted the society asymmetrically, meaning some people are impacted more than others. And so if you're somebody who has invested in the stock markets and you're seeing your S&P 500 index go up by 42%, that's nominal growth in your bank account, versus, let's say, your grocery bill going up by 42%. That doesn't really affect you in any to the same degree as the stock market's going up. So I would say in terms of adding wealth to the people who actually hold these assets, it has actually done so in real terms, for the reasons I've just stated. And actually, if you take a look, and we talked about this before, Gareth, you and I, the divergence in sentiment between the wealthy and the lower tercile of income. The University of Michigan Consumer Sentiment, they have various breakdowns of consumer sentiment, and in one of their surveys, they surveyed the top tercile of income and the bottom tercile of income. And what you see is that they've typically moved in lockstep, except for the latest 2 data points where they've started to diverge, meaning the wealthy have their sentiment has skyrocketed. I don't know if I can find that chart, but if I do, I'll share it on the screen later. But the sentiment has skyrocketed for the wealthy, while for the bottom tercile of income, it's kept going down. And so what we're seeing is a bifurcation of consumer sentiment. And one of the reasons Gareth and I discussed is possibly because of asset prices rising. So I don't think asset prices rising because of M2 have impacted everybody the same way. And I don't personally think that M2, the S&P divided by M2 is probably the perfect way to look at growth in real terms. That would probably just be divided by CPI, although I think that is an excellent chart that Ben put up that may indicate where growth would go in future M2 growth or decline cycles, because what you're seeing is basically a repeating pattern of stocks only growing to the same degree as M2 growth, which I find fascinating. Not surprised, though.
Yeah, very cool.
I think that's a fair way to look at the market for sure. Just because we went up to the same level against M2 in 2021 as we did in 2020 doesn't mean that people didn't feel like they had more money or weren't able to accomplish some more things. Gareth, do you have any views on this chart? Because the other caveat, by the way, is that if you take the drop here all the way down from this level to here, it's a 22% drop. That's not to say that it has to happen this year or next year. Who knows when it could theoretically happen, right? But a 22% drop by the S&P, because again, the money supply went down. So a 22% drop actually puts you exactly at the pre-pandemic high. That's where it puts it. And so I do want, I know you've talked a little bit about the S&P maybe retracing back to that level. Do you think that's still on the table, or have you do you think any pullback would be maybe a higher low?
No, I'm in the camp where at some point something is going to break, and I think the market is very much in the mode of assuming everything is going to be fine. The soft landing, the perfect landing, no landing, as they say. And so to me, it's October lows should be tested by 2024, and I think it'll happen a lot faster once the jobs market begins to show cracks. I think things start to fall apart very, very quickly. So yeah, I'm in the camp that we probably do see that. I think ultimately We'll probably even go lower than that, but I think that would be a huge multi-month bounce level on the S&P and the NASDAQ.
Hey, I've got a question for Ben,
Yeah.
real quick. Can you go back to your M2 and S&P 500 chart again, the ratio?
Yeah.
I'm wondering why actually the S&P has been rallying, and even the NASDAQ have been rallying this year, despite M2 growth falling. And in fact, the growth has been in negative territory, I believe, in for a couple months now. Yet we still see, discounting the last 2 weeks, the S&P has been breaking new highs all year, despite M2 growth falling. I'm just wondering why that is.
That's a great question, David. I think the only answer I have for you is to look at a few things here. Average out every midterm year for the S&P 500. That's what it looks like. Now average out post-election years and election years. That's where they all are. Now average out all pre-election years, which is where we currently are, right? We're in a pre-election year right now. You can see that pre-election years tend to outperform all the other years, right? We tend to climb the wall of worry in pre-election years. And so I think that's what it is. I think that a lot of people came into the year offsides, and there was just, because the recession risk did not materialize immediately, then that, the S&P had to completely reprice itself, right? Because the labor market hasn't faded yet, right? The labor market has remained strong. Therefore, that recession risk coming into 2023 got completely priced out. And that actually happens a lot in pre-election years, is that we climb the wall of worry. Here's another really interesting chart. And Gareth, we talked about this one, I believe, a little bit ago. Actually, let me see if I can find it over here. So this chart, and you can still see I have it on the screen. I haven't even changed it. This is the Russell 2000. And look at this chart, how in the midterm year, it goes down 2014, 2018, 2022. In the pre-election year, 2015, 2019, 2023, it goes up. And then in the election year, it puts in a lower low, right? You can see 2016 was lower than 2014, even though we put in new highs. 2020 was lower than 2018, and we didn't put in a new high. And therefore, there's a chance that 2024 is lower than 2022. So I think the answer to your question, David, is that pre-election years are just simply notorious for climbing the wall of worry. And it often, I think the issue is that a lot of people assume that all these bad things that occur have to hit the economy immediately, but it takes a longer period of time for all these things to sort of filter through the economy. And then by the time we get to the election year, something happens, and we ultimately get some type of a pivot. And the last thing I would say on this is that, Gareth, going back to that idea of potentially retesting the pre-pandemic high. If you look at another period of high inflation, 1946 to 1949, coming out of World War II, we had an incredible rally here. And then guess what happened? It eventually went down and it put in a new low, but it was only a slightly lower low, right? So like imagine a world where the S&P goes to 3,400 and then all the bears say, "Ha, we're right," and then that ends up being the low. And then it just goes down. Right? Like there's a chance that could happen. Imagine, I have to imagine in 1949, there were a lot of people that thought the same thing. And then that ended up marking the bottom.
Yeah, that's super interesting. I agree, man.
Can I show you guys one chart? I just want to present. So this I find kind of interesting, which is federal government expenditures. This looks like a fairly consistent leading indicator for what happened with the stock markets over the last 3 years. If you just overlay the S&P 500, it's not perfect, but if you lead this by 6 months, it's a pretty good overlay. So consistent to the same theory that money supply, where increases in the money supply boost asset prices. Well, what we see is direct government spending and direct stimulus actually also boosts asset prices, and in fact probably moves it to an even more consistent degree, because M2 has been falling all year while the stock markets have been going up. Well, actually the government expenditures and overlays have been going up as well. So I just find that interesting. I think Gareth is frozen.
Yeah, I think he is. Gareth, are you still with us?
He'll probably come back.
Yeah, I think I'll probably come back. I mean, I think we should probably sort of maybe sort of put a bow on it, right? Because I mean, I don't want us to go too long. David, if you had to summarize, what your views are here on the market for the next, I mean, again, one of the things I love about you is that you interview everyone, right? Including Gareth and I. I've interviewed you on my channel before as well. He's back. But how do you make heads or tails? Because I mean, you literally listen to everyone, and you have one guest that'll come onto your channel and say the S&P is going to to 2,000, and then the next day someone will come in and say it's going to 6,000. So do you find yourself in your free time just trying to synthesize everything that you're going through and trying to come up with the most realistic outcome?
Yeah. So for Bitcoin, I think Bitcoin will rally once the Fed pivots, whenever that may be. So until that happens, I don't see it moving. I'm just thinking from the perspective of somebody who would add more to my Bitcoin position. I would do it once the Fed shows signs of pivoting. That's the way that's just my personal bottom line. In terms of my views on the S&P 500, my view is that valuations haven't really been a good indicator of where prices have gone, because people have been calling the S&P 500 overvalued for more than 10 years. And so that to me is not a good indicator of where things are going to go. Monetary stimulus also wasn't a perfect indicator, because like we just talked about, M2 has been declining. I see sentiment on Wall Street as being very, very bullish right now. Where is the big institutional money going, and where are they driving the markets? And from what I've been seeing, they're long, despite the net speculative positions of the futures being net short. But if you just look at the articles of the economists on the Wall Street firms, they're very bullish. Now, in terms of views on the economy, my personal view is that we're not going into a recession just yet. Possibly by next year. By the way, the consensus on my show is that everyone thinks there will be a recession at some point. The people who have said that a recession is happening now, like immediately by September, they've actually revised their outlook until later next year. I would personally agree with that view. If you just labor market is not, despite the periphery being in short-term part-time labor, the overall print is still strong. The CPI number has been coming down, which signals to me that the Fed does not need to raise rates any further, which is good for risk assets. And the consumer right now, demand from the consumer side is still relatively strong. And so, yes, the PMI has been falling. Yes, industrial production has been falling. Yes, we see things like trucking slowing down. But those aren't signs of a recession. They're just slowdowns in particular sectors. What we need to see for a recession, a definitive recession, is unemployment tick up, and sentiment just plummet, and spending plummet, which none of those things have happened yet.
Yeah.
So I'm in the no recession yet camp until those indicators turn more bearish. I'm personally in the camp that until we see definitive signs of a recession, the stock markets will continue to go up. That's not to say that it's not due for correction, and corrections happen all the time, as Gareth knows. It doesn't have to be this major crash. Every time it goes down 90%. I think we might see bumps along the way, like what we saw in the last 2 weeks. But I think my personal view is that the general direction of the S&P will be up until we see more definitive signs of a recession. Keep in mind that not all recessions in the past have been coincided with a bear market, although that usually is the case. So my assumption is that it will follow the historical pattern of recessions leading to bear markets. But again, there were exceptions in the past. So to sum it up, Bitcoin will go up when the Fed pivots, and the stock markets will go down when more definitive signs of recession show up, which isn't now.
Gareth, you agree with that?
Yeah. So I'm one of those that I thought by late third, early fourth quarter we'd be in recession. And David, I talked about that early. Now I honestly think it's you got to push it out till late, last month of 2023 to first quarter of 2024. Just because again the markets have remained resilient. I think the money in the system hasn't been sucked out as fast, even though the Fed's raising rates, there's a lot of money in there that keeps sloshing around. And I think overall it will happen. It's just a matter of how bad is it going to be. And then ultimately I'm curious about inflation, right? Do we have a sticky 3%, which makes it very tricky for the Fed to come to the rescue? Or is inflation, do we import some deflation from China and then they can come out guns blazing and start printing? And I think to me, that's going to dictate the next 5 years, because if they can't stimulate and save the markets like they have in the past, then we could be in a period. And I'd love to hear your views on this of like, everyone's so used to like, okay, we're in a bear market, but we'll be back in a bull within a year and, making new all-time highs within a few years. Is it possible that we get in this cycle of just like kind of crappy markets for a longer period, like Brazil or China? I mean, China hasn't made a new high since '09, right?
I think if the Fed does the right thing, which is higher for longer, I think we could get to new highs. So I guess the thing is if they pivot too quickly, then we could get to new highs, but they might not be sustainable new highs. Like where you do like a 1970s type thing, which you were talking about, where you just kind of slosh around and you don't really go anywhere for 10 to 15 years. And I do think there is reason to believe that, as you guys both said, that there could be a recession and it could be delayed until 2024. But there is one thing that I think we have to consider. Again, I'd say the most likely scenario at this point is likely not until end of year at the earliest, at the absolute earliest, and maybe not until sometime in 2024. And I think David even said maybe not even until the end of 2024, according to a lot of the analysts that he was interviewing on his channel.
The way I see it,
Sorry. I was going to say the one thing, if you could show my screen, Gareth, the one thing I think people at least need to be at least cognizant of is 1987. So remember, markets are not going to repeat themselves. I don't think we can go into 2023 and assume that it has to play out like 1987. But remember, 1987 was a pre-election year. 1987, we had a Fed pivot. 1987, we got this seasonal correction in August and September, and then the market plummeted 20%, and that flushed everyone out. I mean, there was nowhere to hide, right? So when I talk about like a windfall event, if the Fed breaks something, if these long end of the yield curve breaking out, if it causes some type of major crisis somewhere, then you could get a 1987 type environment where it just flushes everyone out and it completely resets everything. If we don't get something like that, which, I mean, again, if you spend your whole life calling for a major crash, you're going to be wrong 99% of the time, right? So you shouldn't go into it calling for this stuff to happen. But it's just to say, guys, look, if that happens, if this happens, the Fed will pivot in 2023 if this happens. Okay. It's just that as long as we continue on kind of how we are, where, the labor market is resilient and nothing really major changes, then yeah, like probably nothing until 2024. But if again, a 20% drop, that's where you get the Fed pivot. And so I just want people to be aware that something like that could occur. And it almost would be somewhat come full circle, right? Everyone goes into 2023 calling for a recession. Then late 2023, everyone says, all right, recession is not till 2024. And then maybe the recession actually ends up being in 2023. It would be kind of funny if we all kind of came full circle and it ended up playing out like that.
Ben, one of the charts that you've shown before is that the search results for soft, I think it was for recession, and how it was hugely high in early this year, but then it died out and we didn't see a recession. And now it's, if we look at past cycles, it's usually a two-pronged attack, right? It's the second time that happens.
Right. Your first peak on recession searches on Google occurs around yield curve inversion. That's when everyone thinks the recession is happening. But again, it's after the uninversion of the yield curve that it normally happens. And then you get the real peak where people actually get laid off en masse. And then again, here in the that was the financial crisis. And then again, here in the pandemic, remember, people say it was a black swan, but look, I mean, we had the inverted yield curve in 2019 and we had a recession in 2020. It doesn't tell you what's going to cause the recession. It just tells you the economy is sick and it's only going to take one event to really cause it, right? Like imagine if we had a really big event happen now, the market might sell off completely. Like if it's like really negative news. But if it had happened 3 months ago, the market probably would have absorbed it just because the momentum was to the bulls, right? But it's all about these periods of vulnerability. And now the market is vulnerable. If we can get through September without any major crisis, then yeah, we could rally into Q4 and then we face the music in 2024. But there still is a chance that the music stops in 2023.
So if you think about why the bulls are bullish, I keep asking myself, what would invalidate their thesis? And surprise them to the downside. And so let's look at the Fed. The Fed having a surprise rate hike would definitely invalidate their thesis and move things to that downside, I think. Why would they do that? They would either do that if unemployment, well, they wouldn't do that if unemployment goes down, but they would do that if inflation spikes up unexpectedly. So at this point, what would cause inflation to spike up unexpectedly? Well, I think that would either come from a spike up in energy prices or a spike up in some sort of supply or a spike up due to some sort of supply chain constraint that we haven't foreseen yet. But I think oil might be a wild card that we have to watch. So a spike up in energy prices may actually be bearish for the stock markets if the Fed reacts to that. It's a bit of a long stretch, but it's something to watch. Another possible catalyst for a sell-off is coming out of China. If you look at why the bulls are bullish again, they're expecting economic strength out of the U.S. to continue. Well, okay, even if economic strength falters a little bit and the Fed doesn't change course, I don't think that'll move the markets much. But what could really damage sentiment is news out of the U.S. that we haven't priced in yet. And I think that's partly what we've seen over the last week and a half that may have contributed to lower prices. So watch for oil and watch for China. What would be the black swans that could move the markets down?
Yeah, I mean, I agree with you on China. I think that's the wild card. Interestingly enough, I've been actually nibbling a little bit on China stocks down here via the K-Web. So just something to kind of think about. I don't know necessarily, and I'll show my chart here. This is more of a swing trade. It's not a long-term bet on China, but for me, it's getting in the range where we've had a pretty steep sell-off on the K-Web, which is the CSI China Internet ETF. And you've seen some really interesting moves. Like if we go to Alibaba to me is potentially putting in what I like to refer to as an inverse head and shoulders, right? You have shoulder, head, and then shoulder down here. And at some point, if this neckline breaks, and you can always wait to play it till that point, but this has a lot of upside to go. I mean, you could do a measured move there. You probably see $175 to $180 on Alibaba. Now, is there risk in China? Yeah, heck yeah, there is. But the pattern itself is not horrendous. And, we did see the Chinese markets go lower last night as they didn't do quite enough stimulus. But I'm in the camp that China's kind of one of the few big countries that kind of can do as much stimulus as they want, right? I mean, they don't have to go to the, Republicans and say, hey, can we raise the debt ceiling? They can just do what they got to do to get their economy on. And I think with youth unemployment at 20% plus, and now they're not even reporting it, like how do you as an authoritarian regime not say, hey, we got to get people to work because we know what happens historically with populations that are out of work. So.
Well, we're about at the top of the hour, and David, I think you're right about the rising energy prices. That could be very negative. In fact, oil often does rally into a recession. Gareth and I have talked about that a couple of times, and we've been following oil for the last couple of months really closely on the No Shill Zone, because as it goes up, that does, again, the cure for high oil prices is unfortunately just high oil prices, right? High oil prices will ultimately lead to probably lower oil prices if it knocks the economy down. But why don't we wrap it up there? I mean, we're at the top of the hour. I've seen a lot of really great positive comments about having David on the show. David, I just want to thank you again for joining us here. And guys, if you're not subscribed to David, make sure you go subscribe. If you're not subscribed to Gareth, go subscribe as well. And we love doing this show. We like bringing people on. David, is there anywhere else they can find you?
My YouTube channel, The David Lynn Report, is my primary platform. You can also find me on Twitter, but all of my work goes on YouTube. You can find Gareth's interviews on there. You can find Ben's interviews on there with me. So
we'll do this again, and make sure to follow Ben on his socials. I think they're all on that post, YouTube and so forth. And again, we hope you guys enjoy. It's not really a kind of a hyped up show. It's more just this is the data. This is what it could mean, and we give you guys that information, and we hope that you can make it into whatever you want to make it into. And that's the beauty of just knowing the data and giving it to you guys. So thank you guys for coming, David. Thank you so much, buddy.
Thank you. What was our conclusion? We're slightly less bearish than 2 months ago. Was that our takeaway from today?
I guess it depends on what you're talking about. I mean, I've been bearish on altcoins for 20 months now.
Okay.
Well, to end, you guys mind if I just throw a couple questions real quick, like one word answers? Does Jerome Powell Friday say that they're going to hike again this year? Ben, what do you think?
Gosh, putting me on the spot. I mean, I don't think he'll. I think he'll just leave it ambiguous. Like, I don't think he's going to say one way or another because that's what he's always done. He's not going to commit. I think he'll say that they'll do what they need to do.
So you're taking C, none of the above.
Yeah, he'll just say, he'll say we'll talk about it at the time. Is what he'll probably say. Yeah.
So my one word answer is no.
No. All right. And then lastly, I'll say, let's see, what's another good one? Do you think that Bitcoin makes a new 52-week low in 2024 or a new low below?
In a new 52-week low?
Well, below 15.7, yeah, basically.
Oh, below
so it's not really 52-week, but
yeah, because it could be a new 52-week low and not actually be a new low.
So take out that low, the 15.7, 15.5.
You're trying to get me in trouble now, Gareth.
You can listen, guys. I want everyone to know, like, listen, this is all just our guesses, right? It's somewhat educated, but none of us really know.
I will say this, Gareth. There is a chance, and I think the chance is higher than people give it credit for. Because if the S&P can go to its pre-pandemic low or pre-pandemic high, then so too can Bitcoin. And so too can ETH. Now we better sign off quickly because now I just got into a lot of trouble.
Oh boy. All right, David, last for you. Quick set. Give us a wise word.
Wise word. Follow Gareth and Ben.
That's wise word out there. All right, guys. Thank you for tuning in. We'll see you next Monday, 11 a.m. Thanks for coming out. Take care.